Hey everyone, welcome to another interview on the Good Soil Investment YouTube channel. We are here again with Vuk Vukovic, who has a really interesting background, a lot of experience on the macroeconomic side, kind of traditional training on the macroeconomic side, as well as a really interesting company that he's founded called Oraclum, which is doing really interesting things on the kind of predictive analytics side across financial markets and presidential elections and all sorts of other things. Vuk, welcome back on.
Thank you, Matt. Thanks for inviting me again back to the show.
We actually did a recording of this about a week ago when Emmet wasn't available, and
we did.
Somehow the video got lost. So we do appreciate you trying it one more time. So
sure,
thanks.
No
Technically, it's our third interview, actually.
It is, technically speaking, yeah. And still, let's make sure that all the conclusions that we said last time, we're going to repeat them now. So it's not like we're updating, with respect to what happened in the market. So I was bearish then. I'm still bearish. So just so we have that clear.
So you're still bearish? Yeah. You think the market's going to continue to kind of trend downwards here? Is that what your thinking is?
I think so. Yeah. I mean, at least, yeah, I think so. Unfortunately.
And so maybe to get the bearings for folks who obviously did not see our last our interview that was lost, but we did speak about 2 months ago, and I think you were, I would say, cautiously optimistic. We spoke through supply chain issues, we talked through kind of Fed policy and reading the tea leaves there, and things seemed like they were maybe overblown in the market. But your position has certainly changed since then. So. Walk us through, if you would, what's changed most significantly in your mind, and then maybe how you see things playing out from here.
Sure. So the basic thing that changed, even though last time I remember when we did the interview, we were saying that we were hoping that the war in Ukraine doesn't start. Unfortunately, I think 2 weeks later it started. And that kind of changed a lot of things. Remember back then you were asking me, and I was trying to explain why I was thinking that inflation is peaking, essentially, why it was peaking in January and February, and there were a lot of indicators pointing to that direction. And then you had the whole situation with the Ukraine war that kind of pushed commodity prices back up again, right? And that really changed a lot of the landscape. And I know that there was that meme, people blaming everything on Putin now. That is a bit funny, but from one point, it didn't cause inflation, obviously, but it certainly exacerbated it. I think it's gonna amplify its effects, at least throughout the first half of 2022, which means that essentially the Fed is going to continue tightening. There's no room for them in basically halting the progress that they're trying to make with raising interest rates. So they're going to keep going. I think it's priced in already at about 2.5% by the end of the year, which is big, which is a huge increase in just a single year. You had the fastest inversion of the yield curve in the meantime. It again bounced back. It was only inverted for like 2 days. But still, it's still a signal, with the bond market sending a very powerful signal, going down, I think, over 10% from the start of the year, from year to date. And now I think equities are about to follow. They started last week already. Throughout the first 3 weeks of April, we're seeing a downward trend, which is interesting, since April is usually one of the best months of the year historically speaking, simply because you have the Q1 results and things are bouncing back. So essentially, yeah, there's a lot of negative signs. Last time we went through a lot of them. We can go through some of them now as well. Sentiment is down, consumer sentiment. A lot of these things they're down to basically to recession levels, and then there's a housing situation, and all of these indicators together are basically pointing to the direction of a downward trend. So last time I was cautiously optimistic. It was simply because of the inflation indicators, but right now I don't see this. I see the opposite direction, unfortunately.
Yeah, so there's a lot to unpack there. Maybe let's start with inflation. Because that was one where we were seeing a lot of the price inflation back in February seemed to be related to kind of the supply chain kind of crunch that we expected to unwind. But in the meantime, the Putin has invaded Ukraine, as you said, and let's maybe take a minute to walk through all the implications that has to commodities and across the world, because the one that was probably most apparent was natural gas prices to the rest of Europe. saw a big spike. But even, in the United States now, we're seeing levels that are, kind of crazy high that we were not expecting to see again, like ever, with how prevalent fracking has become. So, energy prices are incredibly high. And then you're also seeing, I was unaware, for example, what a big exporter of wheat that Ukraine is. And so there's expectations for a very diminished harvest coming out of there, which will, of course, impact, food prices in Europe and elsewhere in the world. So what are the other kind of commodity price pressures that you see contributing to inflation?
Right, all good points. Last time I showed a graph. I'm not going to do it now, just in case everything stays fine. But I have it on my Substack, so people can have a look if they want. Essentially, so if you remember the prices of lumber and coal back in 2021, right? These were the first prices that were going up. So coal prices iron, coal, lumber, they were going up in the first half of the year because of the supply chain constraints that we discussed last time. And then, but you didn't see the effect that they had on other prices until the second part of the year. So we didn't start seeing huge inflation or higher inflation essentially until about April, May, and then from June onwards, especially, right? So we didn't see it in the first quarter last year, even though these prices were peaking essentially mid-year. So what I'm saying, what I'm trying to say here, again, we had a similar spike in coal, in lumber, and wheat especially, and a bunch of other commodities that are coming from the Ukraine and from Russia, important for car manufacturing, for a bunch of other industries. And you can see that these prices are spiking right now, or some of them spiked basically a month ago when the war started. And you're going to see this effect in about a few months' time, essentially. Now, keep in mind that when you look at the CPI data, the main contributor to inflation in every country, from the US to Europe, have been energy prices, right? So natural gas, oil, electricity as well. A lot of electricity apparently is being produced using natural gas. So it's all affecting the prices. And this is kind of, when you think about it, this is affecting companies' bottom lines. So the reason why I'm being a little bit pessimistic here is because I usually like to talk to company owners around Europe mostly. I don't know that many American company owners, but I do talk with a bunch of them around Europe, and they're all saying, yeah, we're trying to switch. So, for example, if you're in the middle of the production line, right? So you have higher energy prices, higher production costs, and you're trying to shift that to your clients, right? And they're going to shift it back to the end consumer, which is all of us, obviously. But you can't shift the entire burden, right? You have to accept some of it, which affects your earnings, obviously, and this affects your profitability for the year, and obviously equity prices will adapt, right? So, this is what I'm seeing in Europe. I think in America it's the same situation, especially because inflation is even higher when you look at the core CPI numbers.
Now, Vuk, what do you think about also this more recent zero COVID policy, China lockdowns? Do you think that's going to contribute further to more inflationary or supply chain disruptions that leads to inflationary shocks again? And is that also potentially a huge macro risk at this point? People are underpricing.
Yeah, potentially, yes. Because remember last time, the huge driver of inflation were the supply chain problems. This is what we discussed, and this is one of my main arguments essentially. And if you look at the situation right now in Shanghai, I think about the last thing I saw, about 600 boats are sitting there. Ships are sitting in the harbor, still not getting filled. And this is going to cause a lot of delays. And when you have these delays with the ships, then basically the entire supply chain kind of back channels, and this is exactly what happened post-COVID when you had into 2021, especially when you had the post-COVID surge in demand, and now we're looking at a similar situation where these ships are stationed there and they're not moving, and this is causing a big strain on the supply side of the equation. When again you still have high demand, so it will inevitably lead to another disturbance in the price levels. That's unfortunately. That's going to happen, and this is another factor why I'm slightly more bearish this time than last time.
Yeah, that's so we were expecting kind of an unwinding of the supply chain bottleneck, but now at least in Shanghai, you're seeing kind of the reverse, where things are piling up again. And then that you mentioned. I'm sorry to interrupt you, Matt. So when you mentioned the unwinding, I also when I speak to company executives, what they're usually saying is, the supply chains have unwinded. A lot of things the Russia situation did send them back, so people are expecting it to last for at least another year, which is not a good sign.
right?
Right.
So, when you look at the main manufacturing companies, at least, that's not good.
Yeah, and it does seem like, there's some companies that are better able to weather the storm than others. Tesla, for example, posted a kind of a stellar Q1 number, and I think that surprised a lot of people. But to the extent that this takes,
that's the other part of the equation, right? This is what we discussed last time. Right? It's very hard to be like, it's difficult to be bearish when you have companies like Tesla or Apple or whatever are driving, the S&P and the markets, and they're really, really good, right? It's difficult to be bearish on those companies in particular. So,
but the overall, what we're seeing certainly though is the overall market. Multiples are compressing, and the market in general is coming down. But you'd much rather own Tesla now than Netflix, for example, because Tesla, even though basically flat for the month, they had to post like kind of crazy numbers in order to just stay flat. Whereas Netflix had a really bad miss, and we're down 40% or 35%, something like that.
True, and even that, like, so last week when the Tesla numbers came out, I bought a small position in the Tesla calls expiring the other day, and I got IV crushed because it didn't move up as fast as I was expecting, or as high as I was expecting.
Yeah. Yeah, I mean, it also seems like that, sometimes I wonder, I try to look at both sides, right? And the other side is, I feel like there's always some kind of geopolitical risks or geopolitical events going on, disrupting something in supply chains, or some kind of countries about to default on some bonds or real estate issues that's going to lead to, I feel like there's always worries. We're just, we're in the business of following the news and information, news reports on the biggest worries there are. And so it feels like there's always risks out there, but this time it does feel a little different, like a little more important to keep an eye on, with China being, such a huge component of the world economy, and commodities prices. There's certainly a shock to commodities prices recently with the Ukraine invasion into Ukraine. So, I don't know. Maybe together they kind of outsize the normalcy, the normal geopolitical issues that are, happening, just about at any given time. But I mean, do you think that do you think that we're just you think the news is just zeroing in more on these things, and we're making it bigger deal than it is because the news is better at zeroing in on this stuff? Or do you think that these are actually legitimately?
No, you're absolutely right. The news bias is always there, right? Whenever there's a catastrophe, whenever there's a disaster, it's good for the news in general. And that's a business model. Essentially, you depend on clicks. I have no problem with that personally. But in terms of how it affects people and their decisions, I mean, you're amplifying the effects a little bit with the media perception. But on the other hand, that's a lot of people are then thinking, okay, maybe we should be contrarian on these signals, right? If everyone's expecting a recession, is it already priced in, right? There was that famous George Soros line. He was saying that, huge crashes usually happen when no one expects them, right? If everyone is expecting a crash, is it really going to be a crash? And that's the thing, right? So I mean, that remains to be seen, obviously. But I think in terms of a lot of indicators are kind of pointing to a negative direction, and we haven't. So, for example, a lot of people were. I remember reading about people anticipating a crash of the bubble back in 2020 when you had a huge rebound from COVID, but I didn't see that likely simply because the Fed interest rates were zero, right? 0.25 or 25 basis points, and whenever the Fed rates are zero, you're not going to have a crash. It simply doesn't happen. But right now, by the end of this year, if it goes up to 2.5%, and the bond markets are obviously signaling that it's going to go into that direction, and inflation expectations as well, then we're probably going to have a downturn because of it.
So let's touch on the yield curve inversion, which you you mentioned earlier. And last time we spoke, you said it was kind of one of the signals that you were watching most closely as an indicator of potential recession. So, as you said, we did see a brief inversion of the 10-year, 2-year, but we've had other commentators, Chamath Palihapitiya notably said, oh, look at the 3-month, 18-month; those are actually diverging. So his argument is that the yield curves are sending mixed signals depending on the duration that you're looking at. What's your kind of view as you're breaking apart those numbers, and what's really the story going on there?
Well, listen, I mean, it's true that when you look at historically, the 3 year to 10 year or 3 year to 18, sorry, 3 months to 10 year or 3 months to 18 month is a better indicator overall of when a recession is actually going to happen. But the 2 year, 10 year is always driving the 3 month 10 year, right? Simply because the 3 month rate is the one that's really, really tightly correlated with the federal fund rates. So right now, the federal fund rate is 0.5, right? 50 basis points. In 2 weeks now, or next week, when is the Fed having, is it next week?
May 4th. Next
Yeah.
Wednesday.
So next Wednesday, it's already going to be 1%, right? So it's already going to go up probably by 50 basis points. This is what the market expects. So at that point, you're going to see that yield curve also slightly inverting or at least flattening a bit. So it's not going to be as steep as it is now. So there is a lot of evidence that the kind of the 3 month thing is a little bit lagging behind because it depends on the Fed actually already raising the rates. So it happens later. And this is what's peculiar this time, because this time we had the fastest inversion of the yield curve ever, right? It inverted 2 weeks after the Fed started raising the rate. Usually it takes, 6 months, a year, maybe even 2 years after the Fed starts raising rates for it to adapt. And this is all, it's emblematic of the whole COVID situation, right? Everything was super fast afterwards, right? In 2020, you had a super strong decline. In 2021, a super strong recovery. And you had inflation coming up really, really fast, almost unexpected at one point. And I think the inversion happening fast, and probably the recession is going to happen much faster than we're anticipating initially. So it's a really strange situation because we never had a shock as big as COVID that was not related. It's a typical aggregate demand shock. Let's face it here. So it's not similar to the 2008 financial crisis. That was something different. That was a structural shock. The Great Depression was a structural shock. What we had with COVID was a typical aggregate demand shock, and it's something that completely disturbed all the supply chains. It's disturbed production signals, and it sent the economies in a frenzy. You had the policymaker reaction that was enormous. Huge monetary stimuli, huge fiscal stimuli, and now we're seeing the consequences of that. Now the Fed has to do very quick tightening, and when it does, so the yield curve is essentially nothing more but a kind of a showcase of what the market expects of the Fed doing, right? So if the market expects the Fed to tighten really fast, you can see this in a fast inversion of the yield curve. Right now, it's kind of steepening up again. That's true. So for the last 3 weeks, it's been going up. So it's been flattening, not going inverted anymore. But again, the fact that it did happen back when it did happen is a signal that something is wrong, obviously. So there is a signal in the bond markets. If you look at the value of all the major government bonds, the U.S. government bonds, and the private bonds as well, so the corporate bonds, both high yield and low yield, so the junk bonds, they're all been going down essentially in terms of value, in terms of prices, right? Their yields are going up, so their prices are going down. And this is a very strong signal that the bond market is expecting something to unwind. It's expecting the Fed to increase interest rate, and you had this huge outflow of assets into cash, essentially. So they're not even going into equities, right? So you're selling bonds, you're not going into equities, you're going into cash for right now. Or money market mutual funds. You can see that demand for money market mutual funds is up. So people are essentially looking to cash right now. They're selling everything and unwinding their positions. When I say investors, I mean like big investors, not like retail investors. I'm thinking like funds, right? Pension funds, etc.
Yeah. So Vuk, what do you think? I mean, you put you cover a lot of data. You have a lot of you've taken a ton of data from all different places to kind of formulate your thesis, which is good. More than me or Matt, and you're studying this carefully, and you follow a lot of other folks that are doing the same thing, kind of. So that's good. So you're sort of our crystal ball for the macro market in some sense. How long do you think how long would you be bearish on like the overall S&P 500 or the NASDAQ, at this point? There's rate hikes getting priced in, and how long does it get priced in? And inflation's being priced in to some degree. Is it not priced in enough yet? And supply disruption from gig shit. So all this stuff gets priced in ahead of, obviously it's forward looking the markets. And so it's ahead of the actual calamity that's happening. At what point of the pricing in are we at now? And how much more do we have to go in your best guesstimate?
That's a great question, and it's a very hard one. It's a very difficult answer to give. I think so we can talk about different levels, right? Target levels that we have. So I've been reading a lot of these, technical analysis that the SPY or the S&P has its lower boundaries of 415 and then 380 and whatever. I'm really not sure. I'm not really a technical analyst at all. I don't really
neither am I
into that.
Yeah.
So that's it's really hard to think about all these levels. In terms of duration, it all depends on so how the market is going to react to these Fed hikes from now on, right? So the last time it reacted positively, from what I recall, right? So when the Fed hiked 25 basis points, the market was going up. Right now, so I think last week Powell said that 50 points is on the table. So now markets are pricing this in. This is obviously what's happening now, and it's gonna last a while. I think maybe a few weeks, and then we'll see it unwind later on. A lot of it depends on inflation numbers, really, right? Remember what happened in December and January? Why did we even have the January effect on the decline of equities? It was because of the Fed minutes that we're talking about, the impact of inflation. It's no longer transitory. The Fed is changing the narrative. As soon as it changed the narrative, people are becoming they're pricing in a more hawkish Fed. Right, that's what happened in January, and now it's happening again. The Fed is again becoming more hawkish. Inflation expectations are going high, and the expectations of what the Fed is going to do are also going higher. A lot of people are actually calling for the Fed to kickstart a recession simply to kill inflation, because as soon as you have recession, demand goes down, obviously, and inflation is a little bit under control. So yeah, I don't want to be pessimistic in terms of saying that this entire year we're looking into a topsy-turvy year where it's going to go up and down, sideways essentially for the rest of the year. I would rather that we have a big decline and then just get it over with and then keep growing afterwards. That would be the easiest thing to do, right? Just trade on the way down and just put the positions back up again. But when is this going to happen? I have no idea. Again, we have to look at the signals. Let's look at what happens with the inflation numbers, and very closely looking at what the Fed does from this point on.
So, how are you, playing in this market right now? It seems like you're looking at kind of very bearish indicators. Are there any things that kind of give you some hope for a bullish turnaround, and how are you kind of personally invested right now?
Well, yeah, I mean, I wrote a piece about that. It was like I was kind of summarizing both the bearish and the bullish arguments, because there are a lot of them on both sides, and we touched a few of them right now. I mean, if you look at on the bullish side, the labor market is stellar, right? The performance has been incredible. Usually, before a recession, before a crisis, you're going to have less new hires, etc. And that's, I think, the unemployment claims are an all-time low in the States and in Europe as well. On the other hand of that same equation is the consumer sentiment, which is down low, which is what we explained. So you have these two kind of indicators that are not aligned with each other. And then if you look at two typical indicators of recessions, of kind of forward-looking indicators of recessions, are new manufacturing orders, which are still high, which are not going down, and building permits issued, which are also high, they're not going down. And that's why that this is affecting. I don't know if you're following the Conference Board, their leading economic index. It's a pretty good indicator. They keep doing this. They're doing it for the past 20, 30 years. They're following economic cycles, and usually it's been very good. So as soon as it starts to go down, about 6 to 9 to 12 months, you're going to have a recession. And some of their indicators are building permits, manufacturing orders, etc. And it's going up, not down in March. I just checked their data last week. They published the March data, and it's going up. And they're saying, despite a lot of economic uncertainty and risk, despite the Ukrainian situation, a lot of these standard forward-looking recession indicators are going up, not down. So that's one thing. On the other side of all this data that we just discussed, the inflation, the Fed hikes, the bond market, etc., you have this kind of real economy indicators that are still okay, even though, as I mentioned, a lot of companies are saying that they're not being able to transfer a lot of their costs to the end consumer, to their clients, and to the end consumer, which will cause a strain in their earnings for this year. And then finally, there's the argument that I already mentioned. When everyone expects a recession, it's probably not going to happen. So we can kind of hold on to that one at least.
Yeah.
But personally, sorry, you asked me about my positioning. So personally, I do kind of given my economic background, macro background, I was taught to trust the bond market specifically. I like to look at a lot of micro level data as well, but then when you look at the bond markets, it is signaling a negative trend at least. So I've kind of shifted my portfolio. So when we talked about last week, I told you that I'm kind of half in terms of. So I'm still long on a bunch of stuff, and then I'm short on a bunch of other stuff. Since then I've kind of decreased a little bit of my long positions and increased the short positions for now. Right?
Yeah, so
I'll take profits when necessary. If the SPY keeps dropping, I'm gonna unwind that position, keep taking profits, and then
so
at one point.
So when we were speaking last week, I mean, you said basically the equities market kind of seemed like a no man's land right now, where it had to either kind of spike up or gap up or gap down.
That was my position. So
that was your position.
I wanted either a high move up or a high move down. I got a high move down, so that's at least for me.
But now you're positioning yourself to take advantage of you further profits if the market continues its downward trajectory. So
I think it's a momentum play from now on. I think right? So like a lot of people unwinding their positions, and because that's the thing that you have with markets, right? A lot of it is algo trading, and when algorithms reach their take profit or stop loss orders, then you get automatic trades going on, and then sending the markets down.
Yeah, and so
I've been through this. I've been through this in 2018. I've been through this in 2020. I kind of hope that it's the same thing is happening right now. I don't hope. I hope it's not going to be a recession or something terrible, but it could be.
Yeah, no, it could be. And so I guess that's the other question, which we've touched on a little bit so far. But you shared some data points and some previous Twitter threads that you have put out, which are great. If anyone's not following Vuk on Twitter, by the way, you should. We'll put his handle in the show notes. But one of the charts that you shared, which I found really interesting, was kind of the correlation between equity returns and the Fed interest rates. And so what you would assume is that after Fed raises rates, that equities would underperform, but that correlation seemed to be essentially immaterial. So that kind of begs the question. If equities are already down, I think the Nasdaq's down almost 20% year to date so far, something like that. How much is this already priced in? And how quick would you expect the recovery? I mean, if you're expecting a recession and kind of a years long situation here, I mean, it seems to me that you're making an argument that equities will be in a prolonged period of either downward movement or maybe slightly sideways, but not any sort of V-shaped recovery like we've seen recently. Is that a fair assessment?
You're absolutely right. Yeah, absolutely. Unfortunately, right? Because as I said, it would be best if we had a long decline and a long upward trajectory. But to me, it seems like it's going to be a bunch of reactions to what the Fed does, because there's a lot of uncertainty in the market because of the inflation numbers, right? And what the Fed is going to do. So a lot of investors are still hoping, okay, so now that the Fed sees that it's going to cause a recession, maybe they slow down, maybe they don't. So it's not really certain what's going on. So we could have a bunch of these upward and downward moves throughout the year, which is, I don't think it's good for anyone. No one's positioned like that. It's to benefit from that, but it could be. But on the other hand, is in terms of like the forward-looking situation, maybe the markets puke right now, and then we're fine later on. That's a scenario that I would love. Personally, but it does depend a lot on how the companies will react. So, looking at the Q1 earnings for some of the companies, you already see some of these negative effects. Q2 earnings, the second quarter and third quarter earnings are still going to send these signals as to how the companies are essentially reacting to the inflation numbers and to their higher costs and earnings. So we should, again, that should send a signal of a more, let's say, I'm going to say reducing uncertainty, even though I'm not sure it will be enough, because bottom line is always look at what the Fed is doing, essentially. That's kind of the easiest. If we have to sum it up in one word, it's like, the Fed. Whatever they do, just follow them.
Don't fight the Fed, right?
Yeah, basically. Yeah.
And I'm curious, do you follow VIX as an indicator? I mean, that's been in the last week, especially. I mean, that's just really rallied strong. I mean, which seems to kind of give an indication that we should be expecting pretty significant swings one way or another. What's your
Which
thoughts?
indicator? I didn't catch
and VIX,
which
the volatility index.
Uh-huh. The VIX, yeah. I'm trading the VIX as well. The UVXY, the ETF, right? Yeah, I mean, it was, for me, it was trading way too low for way too long in the last few weeks when you had really, really low volatility in the markets. So something was up, right? I bought it like 3 weeks ago, and then I doubled down on these positions twice to take advantage of the price going down, and it really paid off on Thursday and Friday and today as well. So yeah, I mean, we could have, again, so think of it in terms of what we went through in January and February and March, right? You had a high periods of volatility in both end of January and February and March, and then a low period of volatility. And I'm from my perspective right now, this could continue to go on throughout the rest of the year.
It's kind of a yo-yoing of volatility back and forth.
Yeah. Again, I hope it doesn't. I would prefer that we have either
stability,
up or down, clear, right?
Yeah.
A clear bear market is even fine if it sends the right signals and if things unwind afterwards. Whereas this market is just
it's hard to read.
It's not helping anyone.
Yeah. Well, Vuk, it's been great having you on for an update. Maybe every once in a while we'll have you back and stuff.
Absolutely. That'd be wonderful.
We missed. I wasn't here in the last interview that didn't get recorded, didn't get uploaded correctly. But was there a charity?
This one is fine. I can see the numbers.
All right. Is there a new charity that you'd want us to donate to? Because we're donating to charity, and we talk about it a little bit at the end of every episode. Is there a new one, or any thoughts on that?
I told Matt. I forgot to check the ones I told Matt last time. I think we're going to switch with the first two, and then I added another one, a third one, right? I forgot which one that was. I'm sorry.
So it was Unbound. I think last time you were on Vuk,
Unbound?
It was Unbound is the new one. Yeah. So last time we donated to Prevent
exactly.
Child Abuse and Scholarship America.
Exactly.
We're actually
now,
increasing the donation amount to $5,000 per interview now. So if you want it all to go to Unbound.
I remember. Yeah, I said that we were going to go for 1,000 each of the previous two, and then 3,000 for Unbound, since that's the new one. So we can have them all at around 3,000 donations.
All right.
I like to do this. I like to level things out. That's kind of
sure
what I do.
And for the benefit of those watching, could you just give a brief introduction of Unbound and why you chose them?
Mm-hmm. Unbound, I think they help struggling families, struggling in poverty, and helping these children and the families itself kind of progress. And I think it's a lot about upwards mobility, which is an issue that I really I think is very important, especially today during high levels of inequality. I think like this intergenerational mobility is the key issue that's causing a lot of inequality issues. So I think it's charity that focuses on that problem in particular, helping families move up the curve, so to speak, and I think it's very efficient in terms of its distribution. I saw like over 90% of the money that's being donated is actually being spent towards the cause, not for like administrative purposes, which is something that I always support and like.
Mm-hmm.
So support for them.
Great.
And
awesome.
Once again, kudos to you guys for doing this. I think it's an amazing thing.
Great. Yeah, no, we're learning about all kinds of cool charities, new ones. I'm actually, it's funny, like the more we do it, the more curious I am about each new charity we discover from this stuff. So it's fueling my fire to continue doing it.
It's kind of a feel good, heartwarming situation. And if you can really actually help someone, even with like a small amount, it's awesome.
Sure. Yeah, absolutely. All right, Vuk. Well, thank you for your info, and always a pleasure to talk to you. And we'll continue to keep tabs with you and stuff. And another one last thing, another interesting macro market indicator that Matt and I have kind of looked at is this. I don't know if you've seen the Twitter thread. Spot Gamma is the Twitter guy, but he saw it. Yeah. He talks about the index puts or index calls. The outstanding. On a very broad level, combines it with technicals, obviously, which is, not necessarily what we believe in, but he talks like, if there's a whole bunch of puts getting ready to expire, then he'll talk about it and talk about the ramifications of that on the market, because the market makers on the side have to buy back the index to stay, delta neutral or whatnot. So
there's also, I saw that account. There's also the other one that's Squeeze Lemon or something like that. Lemon Squeeze.
I've seen that one too. I follow that one too. Yeah.
Yeah, I think it's like the similar line of reasoning, right? In terms of watching the option markets and the volumes and it's interesting stuff. I've never seen it before. When I read the thesis of the Lemon Squeeze guy, and it it made a lot of sense. So,
it's interesting data point too. To sometimes consider. Yeah,
absolutely.
All right, guys. Thanks for another great chat, and we'll see you next time.
Thanks, Vuk.
All right. So
bye.
we'll keep the